Welcome back to the channel, everyone. In today's video I'm going to be sharing with you what I find to be the most important candlestick pattern that you can use in your trading. Obviously there's loads out there, but for me the one that I'm going to show you today is the best one for SMC trading, and it's going to be really simple to implement into your trading and look at it on the charts, do some backtesting and then get trading with it. So if you do find this video useful, please do leave a like and subscribe. But let's get into it. So I'm just going to start from theory again. You might have seen me draw something like this before, or on my Instagram, but let's say you have some price doing something like this. And this is a textbook SMC setup. You've got your range created in this area here. This is your range, it gets taken out, all the stops get triggered, and then price shoots up. And what you're doing is waiting for price to come back to this demand zone here. And then to get in from this bit to buy upwards. And this is kind of all of these would be individual candles or like multiple candles in this line. But what you can do is condense all of this setup into one candle, and that's what I'm going to be showing with you in this video. So the main concept from here is that you've got some manipulation in this area here to create liquidity and induce people to place their sell stops below this point, and then the institution comes in, takes them out and pushes price upwards in the direction they wanted it. So to understand how you can put this into a candle, you're going to have to understand how the candles work. And so if I just go up here on a candle like something like this grey one here, the candle before this white line, this grey one. So just some basics of a candlestick, if you don't know how it works. There's two wicks on either side of a body. The body is made up between the open price and the close price, and then the top of the wick is the highest point that price reached during this time, and the low of the wick is the lowest point that price reached in this time. So in this 4-hour window for this candle and time frame. But what you might not notice is, although looking at it after the fact, you can see that it doesn't look very bullish, but what you'll have to remember is that at some point price was up here, and that looks very bullish. You had price going down and then a strong bullish candle, and so a lot of people are going to think that price is going to continue up, and that's why they place buy orders, and then it gets reverses on them and you might get stopped out. And using this kind of theory, you can apply it to the candlestick pattern that I'm talking about, which is the hammer candle, and I'll show you a few examples. I mean, this is an example of a hammer candle actually, but not one that I would be trading from. So a kind of clearer example of this is this blue bullish hammer candle here, this one. And what you can see is price pushed downwards. Inside this 4-hour window it could have created some liquidity maybe, but it pushed downwards, induced people to sell and induced sell stops, and then it reversed upwards, and it didn't take off, but it could have pushed upwards. And if it had, that's what we would have been looking for. But you're probably wondering how you can use price action with SMC, and to do this you're going to have to use some SMC concepts. So the three that I've highlighted are liquidity, imbalance and break of structure. And so for example in this candle here, liquidity was taken out by the hammer candle, which is the liquidity and hammer candlestick pattern kind of tying together. If there is a hammer candlestick pattern, that means liquidity has been taken because price was shooting down and then it reversed heavily. So that's kind of a crossover between price action and SMC. The second kind of concept is imbalance. So as you can see in this zone here, there's some imbalance. Just highlight that different colour. There's imbalance in that zone, and a break of structure can be seen here. The break of structure may not be necessary. Price could have gone up here and reversed and then continued up. You can choose your own rules. These are the ones that I like to use. Obviously test for yourself, see what works for you. If you don't need a break of structure all the time, you'd rather just get in a bit more aggressively, then that's fine, as long as you're confident that the trend is in the direction you're trading. So here you can see price is very strongly in an uptrend, and so going long you can take a few risks. If there's not a break of structure, there's a high probability that the trend will continue and that you can get in and then take it upwards. But using these three rules or concepts, what I like to do is you can either target, as with all my strategies, you can target whatever you want. You can have a fixed risk reward of 1.5, 2, 3, or you can target the highest point in the structure. So this would give a risk reward of 2.86, which is a very nice trade. And you can see that it obviously does work, this concept, because of how price just taps into the zone and then takes off. Obviously sometimes it will come lower down, but generally in these kind of setups you're hoping for price to just tap in and then take off, which is what it did here. And this is a trade I actually did get in on. I took 3% on this one, So that was very nice. However, there was another setup that I didn't take because I don't trade gold, but just something to look at. Over here, you see this hammer candle. You can see the hammer candle, the body's a lot smaller than the wick, and the wick is going down, and then price was reversed up. Broke structure here, and less in liquidity. Not liquidity, sorry, some imbalance. This in here. So you've got those three. You've got your liquidity taken with the candlestick pattern, you've got some imbalance, and you've got a break of structure. And again, price just tapped into the zone and then took off again. And again, you could have got in, stop loss below there, take profit at that would be 1.86, or you can target 1 to 3, which would have played out as well. Or you can target these highs up here. Just be consistent in where you're targeting for 3.65%. That's very nice. But hopefully this has given you a new insight into how you can use kind of the retail trading techniques, such as looking at candlestick patterns in the SMC kind of way, using concepts and merging them together to kind of find your own rhythm, because that is what trading forex is all about. You've got to find your own, what you like about trading and what you feel comfortable doing and what you understand, because that is the biggest thing. If you don't understand something, then it's not going to work out. So choose some concepts that you understand why they work. Liquidity is a nice one because it's quite easy to understand. You've got stop losses below here. When you're a retail trader, this is where you would place your stop losses. So that creates some sell side liquidity, gets taken out. Now you know that the institutions are looking to buy, so price shoots up, and then anywhere you'd want, whatever your confirmation is, you're looking to buy. So liquidity is a very nice one. That's probably what is the thing that moves the markets. So I can create another video on liquidity with more detail if you'd like. Just leave a comment. And if you've got any questions about either this setup or on EuroCAD or any other pair where you've seen something like this and you want some information on why it did work, why it didn't work, how you can improve your strategy, then either leave a comment or join the Discord and ask a question in there. Yeah, once again, if you did find this video helpful, please check out the other videos on my channel and do subscribe and like the video. It really does help out the channel. Yeah, hopefully I'll see you in the next video. But as always, thanks for watching, and I hope you have a good trading week.